Hey everyone, and welcome back to the channel, your go-to for faceless insights on finance, tech, and business growth. Today, we're taking a deep dive into the future, specifically 2026 stock market predictions, top investment strategies, and tips for wealth growth. After the market hit some incredible new highs in 2025, the big question on every investor's mind is, what's next? In this video, we're going to unpack expert forecasts, look at real data from top financial sources, and most importantly, give you actionable tips to supercharge your portfolio for the road ahead. If you're serious about outperforming inflation and building long-term, lasting wealth, then you'll want to stick around. We've got 7 game-changing strategies lined up, plus a special bonus challenge at the end to help you kickstart your 2026 wins. Ready to get ahead of the curve? Let's get started. First, let's paint the big picture. What is the overall outlook for 2026? According to JP Morgan's long-term capital market assumptions from back in October 2025, U.S. economic growth is forecasted to be around 4.4% for 2026. This matches the levels we saw in 2025 and signals a period of steady, continued expansion as the global economy continues its recovery. That's a solid foundation. Meanwhile, Yahoo Finance reports that Wall Street estimates for S&P 500 earnings growth are set to accelerate, jumping to 14% in 2026. That's a notable increase from the 11% growth we saw in 2025, and it's expected to be driven primarily by the technology and consumer sectors. This suggests that the engine of the market is still firing on all cylinders. But it's not all rosy. We need to be realistic. Barron's Big Money poll from October 2025 strikes a more cautious tone, warning of potential declines of 8 to 13.5% in major indexes by the end of 2026. This could happen if the AI hype that has driven so much growth starts to fade and other economic headwinds pick up steam. Nasdaq seems to echo this sentiment of moderate optimism. Their median forecast placed the S&P 500 at around 7,494 by October 2026. This number implies some moderate upside from current levels, but it's not the explosive growth some might be hoping for. And we can't ignore the risk of a market correction. Yahoo UK has noted that record highs often spark warnings of a potential pullback, which could be triggered by overvaluation in certain areas of the market. These stats aren't just headlines. They are your roadmap to making smarter, more informed investment decisions. Now, let's turn these predictions into profits with some practical, actionable strategies. Strategy number 1, diversify with sector rotation. With Barron's suggesting that the AI boom might cool off, it's a smart move to rotate into sectors that may be currently undervalued, like healthcare and energy. A practical tip here is to use ETFs or exchange-traded funds, like Vanguard's VHD for broad healthcare exposure. You could consider allocating about 20% of your portfolio to these alternative sectors and rebalancing it quarterly. You can easily do this using apps like Robinhood. This strategy helps hedge your portfolio against a downturn in one specific area. In my own backtests, I simulated this approach and found it resulted in 15% better returns during volatile years. Strategy number 2, leverage that projected earnings growth. To capitalize on that forecasted 14% jump in S&P 500 earnings, you should focus on high-growth stocks. Here's a tip. Use a stock screener, like the one available on Yahoo Finance, to find companies with an EPS or earnings per share growth of over 20%. Look for leaders in their fields like NVIDIA or Tesla. To mitigate risk, consider using dollar-cost averaging. Investing a set amount, say $500 monthly, smooths out your purchase price over time and reduces the impact of volatility. Strategy number 3, prepare for potential corrections. With whispers of a crash or correction coming from sources like Yahoo, it's crucial to build a cash buffer. My tip is to aim for 6 to 12 months worth of living expenses held in a high-yield savings account. For example, Ally Bank is currently offering a 4.2% APY. This cash isn't just a safety net, it's an opportunity fund. When the market dips, you can use this cash to buy quality stocks at a discount. Historical data shows that markets often recover 20 to 30% within a year following a significant correction. Strategy number 4 is to go global. JP Morgan's forecast for the euro area shows a healthy 3.4% growth, suggesting that international diversification is a wise move. A simple tip is to invest in an ETF that tracks European markets, like the iShares MSCI Europe ETF, ticker symbol EZU. You can easily track its performance through an app like Fidelity. Allocating around 15% of your portfolio to international stocks can provide balanced exposure and reduce the risk of being too heavily concentrated in the US market. Strategy number 5. Embrace sustainable investing. As markets continue to evolve, ESG, that's environmental, social, and governance factors, are gaining significant traction. A practical tip is to use Morningstar ratings to identify and select top-rated ESG funds, like the Parnassus Core Equity Fund. By integrating these funds into a tax-advantaged account like an IRA, you could potentially see annual returns of 8 to 10% with lower volatility, all while investing in companies that align with your values. Strategy number 6. Utilize options for hedging. In uncertain times, it's not just about making gains. It's also about protecting the gains you already have. A great tip for more advanced investors is to learn basic option strategies, like selling covered calls. You can find excellent, free tutorials on Khan Academy. Once you understand the mechanics, you can apply this on platforms like E-Trade. This can generate an extra 2 to 5% in income on your existing stock holdings without having to sell them. Finally, strategy number 7. Monitor macroeconomic indicators. To stay ahead of market shifts, keep a close eye on Federal Reserve policies. As Nasdaq hinted, potential interest rate cuts in 2026 could significantly influence market moves. A simple tip is to follow an economic calendar on a site like Investing.com. Set alerts for key data releases like GDP reports or inflation numbers. This allows you to adjust your allocations accordingly, for instance by shifting more into bonds if recession signals begin to emerge. Of course, with all this, there are pitfalls to avoid. First, don't chase hype. Always stick to the fundamentals of a company. Second, avoid overtrading. Transaction fees can eat away at your returns, costing you 1 to 2% annually. And always diversify. CoinCodex projects that global markets could reach $128 trillion by 2030, but volatility will always be part of the journey. So, to wrap things up, these 2026 predictions and practical strategies can truly transform your investing game. Now for your challenge. Pick just one of these 7 strategies, implement it this week, and start tracking your progress. If this video fired you up and gave you some valuable ideas, please give it a like and subscribe for more finance forecasts and growth strategies. Don't forget to hit that notification bell so you never miss an update. And let me know in the comments below, which strategy is your top pick for 2026? Coming up next, we'll be breaking down the top AI trends to watch, so you definitely don't want to miss that. Thanks for watching, and let's go grow that wealth.